Rob is hard to describe. A dinner with new friends turned into him becoming an advisor and huge support to my partner John and I. So this episode's super special. He's a seasoned investor, operator, entrepreneur, has bought and sold many businesses.
Everything looks so easy from the outside.
And has 20 plus years of experience in M&As and corporate buyouts.
Financials are clean, you've gotten all your SOPs down, and like all this stuff that you got a nice clean data room, you're gonna have a much easier sale.
I'm your host, Shaun Sharabi, and today I am honored to have a friend, someone who's been a mentor recently as well. He's a seasoned entrepreneur, investor, and operator, someone who's built, scaled, and exited multiple businesses while also basically mastering this world of M&A, corporate buyouts. Rob Levin, everybody. Rob, welcome, man.
Yeah, thanks. Glad to be here.
Yeah, man. I'm super excited. I want to jump into this roll-up and consolidation. And actually, if you can maybe start with, you've seen this develop over the years, right? Probably over the past decade or so. How have you seen kind of this roll-up strategy evolve over the past 5-10 years? And what maybe factors have contributed to the successes or failures in different industries?
Yeah, thanks. I think the biggest change I've seen, and this is not just unique to M&A and roll-ups, but is, I think, pervasive across a lot of different aspects of business, is it's become more democratized, right? So it used to be, you had to be a big private equity shop or an investment bank or an LBO team to even think about making acquisitions of companies, or multiple acquisitions in a space. And now you've seen with the internet and with all of the support and the resources that are out there, it's making it much more accessible for smaller operators or for people who haven't gotten to that level yet to start to consider multiple acquisitions. So I think the biggest change has been in that is that there are just lots more people talking about it and trying to do it. And we can talk about how that's going, but I think the biggest change is now that there's just a lot more. You're in the world of entrepreneurs and founders, and if you go back 10, 12 years ago, there weren't a lot of them talking about rolling up industries or doing it, and now everybody's talking about doing it.
Literally. Do you think that that's I guess, what do you think are maybe some of the positive influences of that versus some of the more like concerning influences of it?
Yeah. I mean, on a positive note, like acquisitions can be very beneficial to a company if they do it right. And that's the key, if they do it right. Yeah. You hear a lot of talk about it, and it's one of these things we were talking earlier about. Everything looks so easy from the outside. You see, Olympic skier, and you're like, oh wow, that looks so easy, but you forget that they've been on the slope since they're 4 years old, 4 hours a day. That's all they ever do, and they've gotten the reps in, and it looks very easy to do from the outside. But what happens is you ignore all the data, right? There's a lot of data, accumulated over years and years and years. McKinsey, Deloitte, these big firms that will tell you that 70 to 90% of all M&A transactions do not result in the value that was perceived at the beginning. 70 to 90%, right? So you would think that if you looked at, anything else and there was a 70 to 90% failure rate, you'd probably, take your time before you started to jump in. But that's not the case. People will look at it and they'll hear a podcast or they'll see a YouTube video, and it just sounds so easy and it looks so easy that everybody thinks they can do it. Yeah. And they're disregarding the fact that the biggest companies in the world who have corporate development teams and lawyers and bankers still can't be successful at these, yet you think you're going to be able to do better than they are.
Yeah. It is actually, maybe let's go to the some of these, from maybe like the private equity side, right? Like I actually have some, friends in this space, and it seems like sometimes private equity throws insane money at this, and almost sometimes questionable amount, and maybe they know something that like we don't, but I question sometimes the proper diligence that goes into play that even private equity takes on some of this, especially when it comes into, I've heard some of very backwards incentives for the teams in private equity, more incentivized on executing on transactions versus the actual potential value and so on. Add backs or anyway. So what, like when it comes from if we go to the more institution side, like from like private equity, where do you see that they really mess up in some of their diligence?
I think you have to go back, and this is going to not endear me to your private equity friends and my former private equity friends, but you mentioned the business that I had back in 2006, 7, 8 in the lending space, and when that business failed, right, because of what was going on in the global financial crisis, it took a little while to run that business off, and there was a lot of chaos. But after that, it took a lot of time to sort of look at like what went wrong, right, what had happened, and I mean there were two big lessons that came out of that. I mean, one is for anybody who's listening to this or watching it, you can do everything right, and then some crazy externality you have no control over and could never see coming can still sink your ship, right? Yeah. So it's yes, there are things that you can do to be resilient in business, but there are also going to be things that you have no control over. So that was one lesson. But the other lesson that you pull out of that is incentives, alignment of incentives. Mm-hmm. That was the big lesson. If you look at what was going on at the time, right? You start from investors wanted more yield, right? Because we were in the zero interest rate period. So they weren't finding yield. They wanted more yield, so they were taking more risk. Banks then fill that gap and say, oh, we'll bring you more yield. We'll figure out how to manufacture a product that does that. Why don't we, look at the real estate market and the homeowner market? And then you work back, well, we need mortgages. So they go to the mortgage bankers, and the mortgage bankers say, hey, I need people to bring me mortgages. So they go to the mortgage broker and say, hey, I'm going to pay you to bring me mortgage, customers. Not qualified, just bring me customers. And if you look at that whole chain, everybody in that chain was doing exactly what they were incentivized to do, except the incentives weren't aligned, right? Yeah. So when you take that apart, you really have to go back and say, what are the incentives here, right? And this applies across the board. This is sort of a global, phenomenon where people, it's rooted in psychology. People will do what's in their best interest first, always and forever. I don't care if they're your employee, if they're your spouse, if they're your boss, whatever. We are wired to do what's in our best interest first, and we are going to do that. So you have to be very careful about the incentive structure and figuring out where people are benefiting. So how does that apply to your question on PE and making, let's call them silly investments or whatever? Think about what the incentives are for the PE firm, right? PE firm raises capital from private investors, institutions, endowments, high net worth people, family offices. They get paid a management fee to manage that money, right? So the first thing is the more money they raise, the more the fee is, right? So incentive one is raise a lot of money. Okay. You continue to collect that fee as long as you're managing that money. So you're not giving that money back, right? The last thing you want to do is return the money to your LPs, your investors, because your fee goes away, right? So you got to find something to do with that money. Well, what do PE shops do with that money? They go out and they buy businesses. So their incentive now is keep that money under management and go buy stuff. Whether or not that is a good outcome or a bad outcome is not top of mind. Yes, they want to have good returns and be able to raise that next fund or whatever. But there's this concept, I started out as an equity analyst. I know you've got a investment business and your partner's been in trading, but there's a term, it's called trading beyond your career horizon, right? So I'm going to put this trade on now. I'm not going to be here when it matures, if it matures. And all my compensation, or the majority of it, is up front. right, is now. So I'm going to do what I need to do now. And if that means I overpay for an acquisition, so be it, right? And like, yeah, you're not going to survive very long doing that every single time. But where you see this mismatch, it's one of two things. It's either they honestly think the business is worth more than it is. For whatever reasons, they have different assumptions about how the business is going to work or where the growth is going to come from. Or they really just need to get a deal done. And I've seen both. I've seen people come in and look at a business that we've looked at. I can think of one off the top of my head where we were a finalist for an e-com business, and a private equity firm much bigger than us came in and paid 2 times what we were offering for the business.
Wow.
And our bid was the next highest bid. There were other people in the process, and they doubled that bid. And clearly, that's the bid that the company took. And afterwards, I just happened to know somebody at the firm. I'm like, what did you guys see that we didn't see? Like clearly, and you're way off everybody else. Yeah. And they had a story that they believed that this was what the company was worth, even though nobody else saw it. Now, fast forward, they were wrong, and they're going to really, really struggle to realize any return on that investment. But that wasn't a situation where they just had to get a deal done. They just didn't understand the business that they were buying and thought it was worth a whole lot more than everybody else did. And you tend not to see, that's a pretty extreme example. Sure. You tend not to see that. But it also belies the fact that, as you mentioned earlier, I have a sort of a wandering background, but there are some, there is some through line to that. And part of it is a lot of these guys who are coming from PE or coming into PE have never run a business before, right? So it's all theoretical to them. They believe that, businesses are run on spreadsheets. And if I just build the model, it will happen. And I think I was sharing with you before.
I've seen some great models out there.
I was sharing this morning, sharing with you that I had a meeting this morning with somebody who was kind of going down the acquisition path, and we were talking about how to look at it. And they are on model, they showed me at the top where you have like the title of everything. They're on model V.19. That means this is the 19th iteration of that particular model. And I'm like, you did 19 of these? And he interrupted me and he said, well, we use A, B, and C too. So they've really done like 50 iterations of this model up till now. I was saying, like, you realize that model's wrong. Like, I don't care how many iterations you do. Stop doing iterations in your model, because I can change 2 numbers in there and the whole thing falls apart. Yeah. So stop the modeling and start looking at, like, what is the business actually underneath this? Why are you doing this? And I'm sure we'll get into the whole idea of the acquisition, the strategy in the first place. But there's just too many, MBAs coming out of these schools, going into consulting, going into banking, who've never actually run a business, building out these models and presenting them as if that's how the business is going to perform. And you've run a business, I've run a business, like, that's just not reality.
No. Yeah, it's always, we talk about this with our investment firm too, like, there's many people who are great investors, but being a great business person makes you a better investor, because you get to speak elements of the language that you otherwise wouldn't be able to if you had never operated it, right? I think I want to back up to the intention side, right? So I think there's 2 places that the angle can come from. One is, hey, we have this really amazing deal. We found this one deal, or we found these multiple deals that we're really excited about. We need to raise the capital to actually execute these deals. And the pressure lies in, like, wow, we really feel good about this, assuming the diligence was done properly, right? Now the pressure is like, okay, let's go raise the money. Then there's the other side of where it's like, hey, we have all this money. Our pressure is we need to find these good deals. And I feel like the angles of those, when the starting place comes from one of those 2 points, in one of these, your brain is almost in this state of you're looking for reasons to say yes, right? Like when you have all this money you're managing and you need to deploy it, you're like, give me anything that shows me yes, yes, yes. And we both know you should always approach things in a downside protective nature of fuck no, this better show me why this does make sense. And I am certain that that level of pressure will force people to be like, oh wait, yeah, this, you know, maybe the financials like aren't showing as well as we want, but they have this like these few little line items that don't really matter, or we can get rid of this really pretty easily, and this financial engineering starts to occur. So that intention, right, where this starts from, and that intention point is really, I think, so influential to it. I guess, do you see that, like, do you think that it's pretty widespread where private equities companies come from, or do you feel like many times it's from one of these perspectives over the other? Like, where do you think most of them, what angle are they usually entering in from?
Yeah, I mean, I think that's a really astute observation. The motivation can really cloud your judgment, right?
Yeah.
Is what you're saying. And so when you, like, one of the things that we did with our fund, and we always had, there was somebody who would source the deal and find it and be the sort of the champion of that deal. And in our investment committee, we always had what we call a red team, like somebody who was there to poke holes, right? Is to tell us why this isn't going to work and really challenge those things and be able to defend them. And you know, it would just depend. And so when you come at it from that perspective, it's like, okay, I got to find all the reasons we should not be doing this. It's a completely different conversation than.
That needs to be ingrained in your system. That needs to be
Absolutely.
ingrained in your diligence, in your system.
Yeah, you have to want to be able to do that. You have to. The problem with a lot of that is nobody. And I'll give you an example of this in a second, but nobody wants to say no to the CEO. Nobody wants to be the guy who blows up the deal. Nobody wants to be, you know, that guy in the room. So even when, and I've seen this happen before, even when so the example I'm thinking of is somebody who is in Hampton, who came to me. He was 10 months into a negotiation of an acquisition, and he was just super frustrated, and he couldn't get the deal done, and he couldn't figure out why. Then we can come back to this in a little bit, because the other piece of that was he's running around trying to find the company, trying to raise the money, and meanwhile his core business is going like this, right? Because he's not paying attention to it. And there's some insight in there as well. But when he called me, he's like, look, can you just help me? I just got to get this thing done. I've been working on it. You know, we just want to put it to bed. So we started to talk about the transaction. And, you know, first thing was why are you doing this?
Yeah.
And the answer wasn't a great answer, right? It was kind of like, well, you know, he had this sunk cost bias at that point. He's like, I'm already into it 10 months. It's going to be this. And so during our discussion, he brought his CFO in to the conversation. And the CFO said to me in a one-on-one conversation, we really shouldn't be doing this. And here's all the reasons why. And I'm like, well, have you told him that? And he's like, no, because he really wants to do it. And he's really invested. And my job's just to support him and all this. Like, no, your job is to protect the company, build the business. And it's a perfect example of, like, everybody could see that this was not a deal you should be doing, but nobody wanted to speak up. So you're right. Like, you have to appoint somebody to say, you need to be the guy. And you have to be okay with that truth. You have to be okay with, maybe this isn't a good idea. And maybe I'm, you know, not the smartest guy in the room. And maybe I should be listening to the people who are telling me not to do this. And what I find is, like, most firms don't have that. Most firms, you know, they want to get consensus around the room and everybody, because think about it. If you're in an investment committee, you know, you're going to be presenting a deal at some point. You're going to want them to vote to do your deal. So you kind of set up this environment where everybody's just kind of like yesing each other. And nobody is willing to stand up and say, hey guys, this is not a good idea.
Yeah. And if that's, I mean, you're almost like set up for failure in the beginning, if that's like, because at some point that's going to come to the forefront and that's going to cause an issue, whether it's in the deal, later in the business, like that mentality is going to be toxic.
And that's not to say that every deal is perfect.
Yeah.
Right. There's a I can't remember who said it, this isn't mine, but it was the CFO of a company that had done a lot of acquisitions, and basically he said is like every company has shit. There's the shit you know about and the shit you don't know about. So like just go into it understanding like there's no, so what you got to figure out is like where is the shit and how do we deal with it? No business is perfect, and that's fine, but it's the stuff you don't know about that's going to come back and bite you down the road. The stuff you know about you can deal with and you know it's there.
So so in this space, right, there's obviously, high percent that don't result in positive results. What industries do you see opportunities for in this roll-up space? And maybe on the flip side, what industries do you think are saturated or facing some serious regulatory headwinds that are going to, have difficult impact?
I'm trying to answer a slightly different way because I think you have to start at the beginning, which is you own. I guess there's two ways to think about it. One is you own a successful business and now you want to add to that business through acquisition. The other is you don't own a business and you just want to consolidate a whole bunch of companies into a portfolio and run it, or flip it or sell it or whatever, right? In the first case, the first thing that you need to do is you need to figure out why are we acquiring a business? What is the destination? What are we trying to get out of this? And given the stats, given the difficulty of it, can we do this ourselves? Can we get the growth? It might be slower, but it's going to be better. It's going to be more organic. It's going to be more ingrained. It's going to go along with our culture and everything else versus buying this business and dumping it in and now having to deal with the integration and all the new stuff, right? So you really have to be clear why you're doing an acquisition in the first place and what are you trying to get out of it? And can this, is there a high likelihood that this is going to work, right?
Regardless of industry.
This is industry agnostic, right? It doesn't really matter at that point. It's understanding why you're even thinking about buying businesses, right? So it's a lot of time, it's a lot of headache. I guess we can talk about the consolidation and the integration part, but that's where most of these fail, right? Is people just don't appreciate. All they look at is, we're going to double our revenue. Well, maybe you're going to double your revenue by buying it in, but you're going to double the number of people. You're going to double the number of customers. You can double the problem. So all of that gets doubled too. And are you really in a position to manage all of that and get the results that you want? And again, that's where 70 to 90% of these do not, return the value that everybody thinks they're going to. When you flip over to where we've just got a bunch of money and we want to go out and buy businesses and consolidate industries, which is the big fad right now, and I use that word specifically, fad versus a trend. This is a fad. Yes, there are some market dynamics, and you can hear, people who sell these courses or services or programs give you all the statistics about the number of baby boomer businesses that don't have a succession plan and all of that, and it's all true. Those are the statistics are accurate. But it doesn't necessarily mean it's a good idea, right? And when I look at these industry type roll-ups, people talk about rolling up HVAC companies, electricians, landscapers, roofers, all of these are very popular right now. The reason, and when they pitch them, they'll pitch them to me as an investor, or they'll, pitch them to others. The whole idea is we're going to buy these at, a 4 times multiple, and we're going to sell them at a 10 times multiple, right? And that's the game, right? And it looks great on paper. Obviously, the math looks awesome. Actually pulling it off is much harder. But one of the things that people, I think, are starting to get a better sense of now, but certainly we saw this in the veterinary industry as an example, right? So when I was running the pet business, the pet investment business, we got pitched on every vet roll-up that was going on across the country. I can tell you, every big PE shop, VC firm, fund, came to us for either money or advice or help or whatever. And we were fortunate enough to be sitting in this position where we were seeing all of them, but they weren't seeing each other, right?
Oh, interesting. Yeah.
So everybody thought like, we're the only guys doing this. We're going to capture the market. We're going to get in there at these low multiples. And what happens is those multiples get arbitraged away the more money that comes into the market, right? So we watched multiples in the vet space go from 4 to 5 times EBITDA, which is still, a little pricey, but okay, I can sort of get my head around it, to 15, 16 times EBITDA. I mean, we saw 2 doctor practices in a suburban area selling for 16 times earnings, right? So for those of you who kind of like aren't, following that means it takes you 16 years just to earn back your investment if the company, continues to be as profitable as it is today, right? Or you need to 16x the business just to get your money back. We haven't gotten a return yet, right? So it makes no sense. And that's one of the big things that, it should seem pretty obvious, but it's one of the big things that we always advise people on is if you buy too high, if your entry multiple is too high, you can't outrun that. It's almost impossible to do. So there's a threshold that if you breach that, doesn't matter like where the market goes, you're not going to outrun it. And that's one of the things when you look at these markets is as they heat up, I always like to say to people who come to me, it's like by the time you hear about it at the country club, it's way too late. Right? It's that ship has sailed. You're not going to make any money in this. You never want to be the last guy in, right? And you don't want to be in a very, very crowded space. So I know it doesn't say what, but that, again, applies to any industry, right? So as soon as it starts to get hot, as soon as people start to sort of pile in, you can just anticipate that it's a supply-demand issue, right? There's more people looking for the same amount of companies willing to pay more money, and you're going to find a much, much harder time if you're not disciplined. If you say, hey, I'm only going to pay 4x, well, then you've got to be prepared to say, well, maybe we're not going to be able to pull this off because, as we talked about earlier, somebody's going to be sitting on a pile of money and just be willing to, to pay more or pay a ridiculous price. And there's some other things inside of that if we want to talk about the integration. But that vet space I keep going back to because it was the perfect example of how not to do this.
Do you think so? I like the way you answer that. Actually, it's funny. I feel like it's one of the questions people ask investors. Like they'll ask us, is what industries do you focus on? And like, there's some industries that there's a very low chance that we'll be exploring. Usually, it's things that are the hottest fad. But generally, it's industry agnostic, and it's more of like what's the opportunity and what's the reason for that, right? Something can be a good opportunity at 2 times free cash flow, and some other thing could be a great opportunity at 4 times free cash flow. So is there do you think if you were looking at this space and you're thinking of what's saturated, what isn't, what are people not looking deeply enough into, would you approach it less from the industry standpoint and more from the diligence strategy plus the integration plan plus the exit plan versus like if the industry is in or out of favor? Like, is that how you would more so approach it? Or
I think what you're getting at, and you and I and your partner have gone back and forth a lot on your investment strategy, and he's a super thoughtful guy, and I think what I read from the way you guys approach it, and I think it's the same thing here, is it really comes down to fundamentals, right? Is this a fundamentally good business, and is it going to continue to be a fundamentally good business for that industry, right? And like you said, some industries, have different fundamentals around them, right? A SaaS company is going to have very, very high margins, and a roofing contractor is not, right? So there's going to be different requirements, and there's different fundamentals based on the business. So you've got to look at fundamentals first. Always go back to fundamentals. The second part of that is, yes, if you're doing M&A, the integration, which put a pin in and come back to, because that's a whole nother discussion.
We'll definitely get into
but that's obviously critically important. And I think the third way you've got to look at it is it's very hard not very hard. I would say it's impossible to predict where the market's going to be when you're ready to exit, right? So, lots and lots of people made investments in 2018, 2019, thinking, okay, 5 years, we'll IPO this thing, we'll sell it off. And the IPO market's basically been shut for 24 months, right? So now what, right? Everybody looked at it back then thinking that those conditions would persist for the next 10 years, 15 years, and we're going to be able to exit this thing easy. And then the market changes, and now what, right? So I think you want to model like what the possible outcome could be, what the possible exit could be. But I think it's really important that you say, well, what if we had to hold this another 5 years? What if we had to own this business beyond that time? What would we do? And the one group, I hate to keep harping on the debt space, but the one group that has actually done okay in that is one that understood how to run those businesses. So when the investment time horizon came and they couldn't exit the business, they're like, okay, we can run these things. We can hold on to them. We don't have to fire sale them. We don't have to, get out for any price, because they were prepared to hold on to them for a long time. Other firms, they're selling them off in a fire sale right now because they have to. They don't have a plan B. They don't know how to operate the businesses. So, if you're looking at it, I would, everybody says, you should have a base case, best case, worst case model, but you should also have well, what if we have to hold these for an extra 5 years, right? What does that look like? Are we prepared to do that? That's really, probably your worst case scenario, right? Because if you're buying good businesses at a good price and they're performing, you should be able to hold on to them forever, right? So, but that means you have to run them a certain way, and you have to do things, you have to reinvest in the company. You can't just load it up with debt, strip out everything. When you see a lot of the fund investors that are going into this, their only tool that not the only, but the big tool they have is we're going to cut out costs. Well, you can only do that for so long, right? And there's a point where you can't cut costs anymore, and there's a point where it starts to impact the product and starts to impact revenue.
Yeah, I've heard too much the plan in making this a strong investment is we're going to make it more efficient. We'll cut costs and throw technology layer on it. And it's okay, first off, that can't be the only thing. But second off, if so much of the plan is just focused on cutting costs, to your point, well, what happens if you actually do need to hold on to it for years and years to come? So before getting into integration, on the acquisition side, where in the diligence, what do you think people don't spend enough, where do you think they don't spend enough time on the diligence? Or where do they miss, they have incorrect variable assumption in that?
Yeah. I think the biggest miss is they don't spend enough time on the culture and the people. They're looking at tax returns, they're looking at financial statements, they're looking at vendor contracts, they're looking at tech stacks. That's all fine, and that needs to be part of it, but that's not what runs the business. What runs the business is the people, right? What is their culture? How have they been, how's the company been run for the last 12, 13 years before you showed up? Is it one where they're super stingy and they don't spend any money and they hire B people and it's, there's a lot of employee turnover and, it's just a bad culture? Or is it one where they're continuing to reinvest and they've got a great culture? Because what you're acquiring is you're acquiring the people, right? That's what you're getting at the end of the day. And the amount of time people spend on that part versus, going back and forth around adjusted EBITDA and,
we could raise the price this amount.
Right. All of the financial metrics and things, because that's the easy part to do is you can throw that in a spreadsheet, hand it to some analyst and they'll, run with it. But, you've really got to see is who's going to be working in and running this business after the acquisition. And do they share our values? Do they share the vision that we have? One of the, I guess that would be the, as a kind of a follow-on or an adjunct to that is they assume, and again, I'm going to torture this vet thing, but they didn't, when these guys are buying these vet clinics, I just say guys in general, but when these firms are buying these vet clinics, they failed to understand the vet's role in the practice post-acquisition. And they just thought, well, we're going to come in, we're going to buy your practice. And they had in their plan, okay, we're going to get everybody on the same IT system. We're going to get everybody purchasing from the same set of vendor contracts. We're going to get everybody buying their equipment from the same place. They failed to read the vet into that story. And they thought, well, we bought the business, so you'll do what we say, right? If we tell you you're going to change your practice management software from, ABC to XYZ, that they'll just do it.
Yeah.
And meanwhile, the vet has no interest in doing that. And you're telling him now, and he has all the power in that relationship. If the vet walks out the door, you've just spent $5 million on 4 walls and a nurse. That's not the business. And where it does work, or where I've seen it, be successful, is you share that journey with them up front. This is what our plan is. This is what we intend to do. We plan on replacing your software. Are you okay with that? Tell us, because this is going to be this is what you're signing up for. Do it up front. Everybody's afraid to do it up front because they think, oh, they'll get scared, I'll lose the deal. Better lose the deal there than to spend the money and then fight with this guy, 12 months from now when he's still not implementing the software that you wanted and you anticipated, and the synergy you're going to get out of that and all the rest. And then he walks out the door, right? Or some key person walks out the door. So I think it's spending more time on the culture and the people around the business and being transparent about what you intend to do, rather than just saying, hey, I gave you this big check. Now, I'm the king and you have to do what I say.
So more on the practical side of that, what do you think that actually looks like, right? I understand that, bringing the owner into the plan and so on, because obviously some of these people maybe are just really don't want an earn out, or really unexcited, so are not going to do high quality work. But what else? Would you as far as boots on the ground, understanding, talking to the rest of the management, talking to entry level people, seeing the facility, what other culture diligence would you do?
I think it depends on the business, obviously, but one is just go there, walk around, see the people. What is the atmosphere like? Are they happy? Are they miserable? Are they, look at employee turnover, right? Yeah. How much employee turnover do you have? Where is that turnover coming from? Try and talk to as many people as you can. I understand there's some sensitivity, they don't. Some people are like, oh, we don't want to let people know that the company's being sold. I think that's a big mistake, by the way, because it's much worse for you to wake up and find out the company's been sold. And then, because the first thing is, if you're that employee, you're the first thing you're thinking is, am I going to lose my job? Who am I working for? You're freaked out. But if you say, hey, look, we're entertaining this. Trust me, people will, they will appreciate that, right? So, again, that's a cultural thing, but I think the more you can spend time with the actual employees, or at least the key people in the organization, you'll learn a lot. They will tell you a lot, believe me. I mean, if you sit down with them, have a cup of coffee, take them out to lunch, to sit there, they'll be honest with you about the good, the bad, the ugly, and they'll also tell you things because you ask a question. It's well, what do you think you're missing? What would you like to have that you don't have now? Yeah. Where do you think there's opportunities that the company's not going after? And they'll share that with you. That they want to share that with you, because if you're coming in and saying, we're going to come in and we're going to give, we're going to, take over the business and we're going to, we want to grow it. They're excited about that. They like the fact that and even if they like their old boss, they understand, companies change hands and, people sell businesses, and that happens all the time. But they will share that with you. So if you can, just spend as much time as possible with as many people in the organization at all levels, and just see what they're like, right? Look at their employee turnover. And then there's other things you can do. It's just ask them, do you have mission, vision, values? Does that do people? And if a company doesn't have it, you're like, okay. I mean, it's not a automatic no, but it's sort of like, well, that's curious. Why not? You've been around for a while, so there are things that you can do. The other thing which we always do is we talk to customers. Right. So we get a list of people that they've done work for or that have contracts with, and we ask them like, what is your impression? How's the guy?
Who are you saying you're what's the presentation to that customer on who you are? Just
companies do customer surveys all the time, right?
All the time.
So we're doing a customer satisfaction survey for JS Capital. We understand that you're a client of theirs for some time. We'd like to ask you a few questions about your experience with them, something like that. So, it's true. I mean, you're not lying to them. It is a customer survey. And that's an easy way to do that, right? You can talk to their vendors, right? Do these guys pay on time? Are they a pain in the ass? Are they always ordering stuff last minute? Like, you can get a pretty good picture of how the business operates without ever looking at the financials, right? And I think that people need to flip the script a little bit and spend more time on the actual day-to-day operation of the business and less time around the just going through their tax returns and financial statements.
I mean, there's so much truth in that, just even beyond the roll-up consolidation space. Just like, I feel like management 101, like I remember a lot of mistakes I made in my career of like so much time spent around a table on a call, and like then I would spend a day at a facility, and I'm like, I learned like I got 10 times more out of this than like hashing out like, oh, should we do this, this, and this, or what about like you see it, you feel it, you touch it, you hear people might say one thing, but you see this whole other demeanor on them, and that could be the GM of a location, which is like so pivotal to the success of it. So there's so much truth in I think just business overall, and like the influence and impact of culture on it and the people of it. I guess my follow-up question on that would be, getting more into the integration side, is when we're talking about the seller staying on versus leaving, new owner culture, that like, what do you have like a flat or like a consistent suggestion or strategy you think that's always best? Or is it more, almost sounds like you're coming from this angle of just the inclusion and the openness of communication on it? Like, how would you approach, I guess, that new owner coming in, seller staying on, potential earnout, navigating the culture? Yeah, how would you approach that?
I think you put it into two buckets. One is, are you acquiring this? You're an operating business and you're acquiring another business into your company versus I'm just building a portfolio roll up over here. Because over here, you need those people to run that business.
Right. So two different strategies.
If you're acquiring the business in, my suggestion is make that transition as short as possible. Because what will happen, and again, it's human nature, if I've worked for you for the last 10 years and you sell the company to me and you're still around, those employees are still going to identify with you. They're still going to go to you. And it's hard to make change or to sort of shift direction when the old owner is still in the building or around the building, right? And I've seen this happen where, you have a new CEO, this person, takes a biz dev role or whatever, they're still there. And they have a lot of institutional knowledge, so you do want to keep them around for some period of time. But I would keep it as short as possible in that scenario, because I'm gonna say to Jane, hey Jane, we need to do this. And Jane's going to be, okay. And then she's going to come to you and say, do I really need to do this? And if you're not on board, or you might be like, well, it's their company, you ought to do it, right? And you're not enthusiastic about it. Jane's going to go back to her desk and, try everything she can not to do that. And a month later, you're going to be like, hey, Jane, did you do this? And she's like, oh, no, I'm getting to it or whatever. And it just causes too much confusion. Yeah. People just need to know, like, okay, old owner out, new owner in. When you do that, you have to bring everybody together. Look, there's some best practices, around this, but you have to put yourself in the shoes of the employee, right? When you, like, the first thing that they're going to want to know is, am I going to lose my job?
Yeah.
Right. And maybe some people are.
Yeah.
Right. And where that becomes really toxic is when you do it one by one by one by one. Because then everybody's on pins and needles every single day coming in, am I next, am I next, am I next? And I've seen that where, firms think that that's the right way to do it. Yeah. And they have this strange psychology behind it because that's going to motivate people to work harder, and they're going to fight for their jobs, and they're going to want to prove themselves. Mm-hmm. And in reality is nobody wants to work under that kind of pressure. Nobody wants to be in that kind of environment. And anybody who can leave will. Yeah. And what you're left with is all the people who can't find jobs other places. Now that's what you're dealing with. And you either have to rebuild, and you can't bring, the old trope of A players like to be around A players. Yeah. You're not going to be able to bring in high quality people if you've got a bunch of C and D players, because that's all that's left. Mm-hmm. So if you're going to make cuts, make them all at the same time, and then you bring everybody together and say, if you're in this room, you're staying, you're here. You don't have to worry about it. There's no more cuts. We're not doing anything else, and you can all rest easy that you're going to be in your jobs. And so it can be a tougher way to do it because you're doing a lot of firing all at once. But trust me, rip the Band-Aid off, do it, get it over with, and reassure everybody you're here, you're staying. Yeah. And then you can start to, implement new things, bring in new people and all of that. But I think that, all the data and all the research and, backs this up from direct experiences. The first 90 days after an acquisition will determine whether or not it'll be successful. Well, that first 90, you screw up that first 90 days, you've dug yourself such a hole that, you wouldn't think. And 90 days goes by like this. Yeah. 90 days is fast. So you need to have a plan well before you close on what's going to happen in that first 90 days, and you need to be all over it. And that goes for either situation.
So those first 90 days, what are the most important elements of that? It sounds like the people, culture aspect.
Yep.
Absolutely. What else?
It's like you said before, it's communication. This is, everybody's going to be nervous, or they're not going to, it's all new to them, right? It might not be new to you, but it's all new to them. So you need to be overly communicative in those first 90 days. You need to tell everybody what's going on, what to expect, what changes you might be making, what direction you think you're going to take the company in, how things might change for the better or for the worse. One of the companies that we acquired, they had a call center as part of the operation, and when we went into that, the call center employees were incredibly frustrated, and they were and you can just see it on their faces, even if they were trying to, sort of put on a good face. And we talked to them, it's like they had, I think the newest computer in that place was 8 years old, right? And they're like, this is super frustrating. So I'm on the phone with somebody, it takes 8 minutes for me to just scroll through screens. Yeah. They're getting angry, we're getting angry. It just makes it tough for us to do our job. We want to do a good job. And, so we tag that as, okay, this is not a heavy lift. Let's just get everybody on brand new computers. And, right after the acquisition, CEO went in and said, everybody's getting it. They were thrilled. They were like, we're communicating this. We hear you. We see this as a problem too. You're all getting new computers. And they were like, this is great. Just that one little thing. One, it showed you cared about them. Totally. And two, you communicated it to them, so they were expecting it, right? So they knew it was going to happen. So you just have to over communicate, and you don't have to go into the same detail you would do in your board meeting or with your C-suite, but you kind of want to give them some idea of, I always position it as why we bought the company. This is what we see. This is where we want to take it, and let the people know so they can kind of get on board. They can sort of start getting aligned with what you want to do. So it's not a surprise to them, and they understand what the destination is. and they'll help you get there, right? You don't want to just come in there and rule by fiat, right? By coming in those first 90 days and sort of just walking around with your arms folded and, trying to scare the shit out of people. Like that never works.
Yeah.
So I just think in the first 90 days, have a plan, communicate what that plan is, consistently update people on what that looks like. And then just tell them, your expectations.
Yeah.
Like, what are your expectations? I think, it sounds pretty simple, and there's that old thing about like simple but not easy.
Right.
It's pretty simple, but too many people get caught up in, all the strategy and, all the other nonsense that goes on, and they fail to sort of, like, you've run a company.
Yeah.
It's people. Like it all comes down to people, right? And if you don't appreciate and pay attention to the people, you can have all the spreadsheets you want.
I always said a business is just a group of people that are making decisions and understanding how, what their priorities are. Like, people talk about mission, values. At the end of the day, what that's trying to say is, like, here's what we care about and here's how we make decisions. But at the end of the day, like, it's going to be people that are going to make some type of decision, which is going to guide what that company does. And I mean, so much of this like has been a lot of like reflection I've had over the years of like, oh my God, this thing that like kept me up and where I screwed up, all it took was like a little bit better communication, a little bit like have the difficult convo up front and in the beginning, because it saves you all this shit downstream.
Yeah.
It's so communication.
But to further that, like, yes, people, it's a group of people coming together to solve a common problem or achieve a common outcome. And they do, and it is important to know how those decisions are made. But, the other thing that I think people lose sight of is everybody wants agency, right? They don't want to be told how to solve the problem. They don't want to be babysat. They don't want to be micromanaged. Right. They want to feel like they have some agency in the process, right? So if you just come in and you're prescriptive and you're telling everybody what to do and how to do it, that's taking agency away from them, right? What you want to do is you want to say, like, look, this is where we're going and I need your help to get there. So, here's where we want to go, right? Or here's what we think is possible. And I need your help to get there. I want ideas from you. Like, if that idea comes up through the employee ranks, it is going to get done so much better if you just mandate it down, right? And there are going to be times every leader is going to have to sort of put their foot down and say, okay, we got to do this because we're going in this direction. That's fine. You can't have a company, that's sort of totally run, by, democratically. But at some point, you have to give people agency to make decisions and run with them. You don't want them running off a cliff, but you want to do that. And I think there is not enough of that transfer of agency over to your employees.
Yeah, it's a difference between like the focus on being really clear and articulate on what the objective and result is, like what the target result is, versus like how to achieve that result. And I always found it fascinating when some people, and even my own company, is like they knew how to do something, but they didn't necessarily know what the intended result was,
why they were doing it.
Exactly. And that was like always so backwards versus like, well, I know the reason for this. I just like maybe need some help crafting, which is perfect. Yeah, of course. That's what management teams are for.
And by the way, when you do it that way and you say, hey, look, this is the outcome that we want to get or the product we want to produce, the wisdom of that crowd is going to get you there a lot better. Like, there are going to be ideas that those people have because they're in it every day. They see it. They talk to customers. They talk to vendors. They work on their systems. And they're going to be able to pull up stuff that you're not going to see because you're not doing that all day. So it's a really, I wouldn't say untapped, underutilized resource that you have sitting right there.
Yeah.
And they want to help. And they want to feel like they've taken part in getting you there. But too many times, we just ignore all of that and we just say, hey, this is what you want you to do.
So when it comes to the, like, I feel like a lot of times people are putting a lot of value in this economies of scale concept, right? With these roll-ups, where do you think is the biggest like misconception with that?
biggest misconception, well, with economies of scale, I think you have to define what does that mean, right?
Yeah.
Economies of scale for what, right?
Yeah.
Is it that because there are certain economies of scale, right? Where if you're going to buy 10 glasses versus 10 million glasses, you're going to get better pricing on each individual glass. So those can be realized. You have to do it the right way, but they can be realized, right? So there is.
Yeah, there's like a material,
there's an objective
right
economy of scale that you should be able to get. It's where I think people miss is they start to take that and they start to apply it back to people, right? And they think
we need one F&A team.
Right.
We have 5, we need one.
Right. There's going to be this
HR.
Productivity gain because I'm going to be able to eliminate all these people, and all that money is going to immediately drop to the bottom line, and we're going to do this. And you don't need 4 CFOs, but that doesn't mean you need fewer people in finance because now you have more people, you have a bigger business, and there's also a leveling up, which I think you can appreciate, which is just because you're the CFO or the VP of finance or whatever of a $10 million business. That's not the same skill set you need to be the CFO of a $100 million business, right? And people, that economy of scale, they think that person will grow into that role, and they won't. Right? They
totally different roles.
Totally different roles. And if you really want to get there, you're going to need somebody who's been there before in that skill set. And if you wait too long to go out and get it, you're going to miss a lot in between.
Yeah.
And so there are the real economies of scale that you can get, equipment, but like that stuff. Yeah. Sure, you're going to realize that. But there's too much emphasis put on the productivity side of it and the gains that we're going to get, and we're going to be able to double revenue, and we won't have to hire any more people. Well, that's just not the case, right? You're just in most of these businesses, you're going to need to bring more people in, which means maybe these are lower paid people, but that also means more people to manage, more people to hire, to recruit, to retain. And there's an organizational drag that creates in these businesses, and especially when you're talking about these service businesses, plumbing and electric, like people, you can't double that. So the vet, again, going back to the vet space, you can't just print a new vet. Right? So, we're going to expand our footprint to another 200 locations. Well, that means you need at least 200 vets. Where are you going to get them from, right? If they just started vet school today, you're 7 years before that person can run your practice. What are you going to do in the interim? Yet they'll show you projections where they just heap up. We're going to open clinic after clinic after clinic after clinic, and they haven't given any thought to can we really hire vets? That's an obvious example, but same thing. Can we hire more plumbers? Can we hire more mechanics? Can we hire more roofers? No. So your growth is going to be limited by that one variable in the business. I've seen, people doing these roll-ups in those spaces, and they're like, we're going to change the marketing, we're going to do this and that, we're going to bring in all these new leads. I'm like, great, how are you going to do the work?
Supply and demand management.
There's still somebody who has to go out there and, put the water heater in.
Right.
Who's that? Where is that person?
Yeah, I think it's interesting thinking to your point, right? Managing a business, a $10 million business, is very different than a $100 million business. And I feel like a lot of people see these central functions of systems, IT, customer experience, F&A, HR, and there's that kind of blanket assumption of centralize it and now as a percent of the overall P&L, it's lower. One of the things I think of is what are the functions? There's some functions obviously that you do want to centralize, and then there's some that you actually want to keep local, right? I don't know, take customer experience as an example, and technology and AI is influencing this as well. But how would you, not even just the customer experience, but all these functions also in I think specifically the IT and system development side, right? Because in theory, the bigger you are, the more robust your systems, the more robust your CRM, so on and so forth. Where in this integration world like how and where do you see that falls in, right? You talked about first 90 days are really important, communication, people, and so on. What about this next phase of like, okay, like the actual teams, the actual systems, so on and so forth?
Yeah, I think part of that starts up front, which is, is this take your, I don't know, your HRS system or your CRM, right? You have CRMA, you have HubSpot, and somebody else has some homegrown thing that they've been using in Google, right? Yeah. So obviously you're saying, okay, we need one CRM for the whole company. Well, how easy is it going to be to get the data from here to here? Like people always underestimate how much work that's going to be, right? Absolutely. And they just assume like, oh, we'll just smash these things together. But then, but you understand, you got all the data mapping that has to get done. You've got to actually transfer that stuff out, and is it in 2 different formats, and are they even compatible, and what do we want? Like, it's, people gloss over kind of the actual, how hard it's going to be to integrate these systems. And a lot of company, and remember, you take HubSpot, like just use that, like, right? And over time, you've customized it to the way you want the business to run, right? So you have certain fields that mean certain things. You collect certain data. Well, that company you bought, they're using something else, and they have their own different, like, well, how does that, and if you haven't really thought through that, a project that you thought was going to take 90 days and, one of your developers to do ends up taking 3 years and, your whole engineering team to pull off, right? So you've got to understand, like, what am I looking at going in, and how easy is this really going to be? And then you go, even further where they've built proprietary systems. They built their own stuff. And that's always a nightmare. Like if you're trying to like centralize it into, one platform that might be commercial software, people say like, oh, we're going to get off of this. We're going to get one ERP and all that. But meanwhile, they've been running this thing on QuickBooks and Google Sheets and, some software their developer spun up, and that's not going to be an easy transition. Right. And remember, all throughout this integration process, you still have to run the business. The business still has to continue to make money, right, to do all this. So you can't shut everything down, go away, fix it all up, and then open back up again. So your dev team is probably already pretty busy, right? They're stretched as far as they can go usually, and now you're going to add these projects on top. And I've asked people who are doing this, I'm like, okay, who's going to do this? They're like, oh, the engineering team. I'm like, no, who's going to maintain the existing stuff and build out your product roadmap the way that you're anticipating it? They're going to do that and this. And that's not going to happen. So the really successful ones who I've seen is like they will take that and offload it to a third party, a consultant, and they'll look at it as like, oh, it's too much money. At the end of the day, you'll save money by leaving these people alone. Build a sandbox over here, let them do that, and then one day you'll flip everything over, right? You'll run in parallel for a while and you'll flip over. So it's just being thoughtful about all those little things. Like, we've all, heard the trope, then you do construction in your house. It always takes 2 times as long and costs twice as much, right? It's the unanticipated stuff. It's the unknown unknowns that you as a good, corporate dev person or ops person is like, you have to anticipate those things and build them in, both in time and money up front. Because if you're, and this is where, going back to your PE question earlier, this is where a lot of the PE firms get themselves into trouble, because they lever these companies up so much that they are running on razor thin cash margins. And when a problem comes up, now it's like, oh, now we got to put money back into the business, and they don't want to do that.
Yeah. I also think of like we mentioned it earlier, but the kind of financial engineering, quote unquote, but when you're looking at this optimization piece, I feel like there's optimization that's like, okay, this is good cost cutting. But then there's optimization or development that's actual like additional value creation, right? And value add. What do you think are like the true operational levers to kind of actually create value in this rolled up entity versus just pure cost cutting?
I think it's pretty simple. Again, not easy, but pretty simple. Is like you really have to start with the customer, right?
Yeah.
At the end of the day, like no customer, no business. Like why is the customer doing business with us? And you need to make sure that you don't jeopardize that at any point in time, right? It's not like, the internal stuff, what looks good on a balance sheet or it looks good on your P&L if you don't have a customer on the other side of it. So you really have to work back from the customer and say, hey, if we cut this, and this, how's it going to impact the customer at the end of the day? Forget about, the other side, because, if it's like you don't want to get cut too close to the bone, right? Like there are, not to say that there aren't redundancies and there's not, bloated bureaucracies in some businesses, and that happens over time. But you really want to make sure that whatever cuts you're making or whatever changes you're making don't impact the product that the customer is coming to you for.
Yep.
And if you work back from that, I think it becomes really apparent, very quickly in terms of, if we take this away or we cut the dev team down by half, and we're a SaaS company, like the product's going to suffer and the customers are going to leave. And sure, we may have saved, $500,000 in salaries, but we lost $5 million in customer at the end of the day. So, you really need, I think you just need to start with, like everything else, is like start with the customer, work your way back.
I love almost so many things come back down to just like, it's like communication, your people and your customer. It's like revolves around that. I want to go a little more into the financial side of it, and then kind of where exits play into it. And we mentioned like the multiple arbitrage element, but I want to unpack that a little more. One question, when it comes to this cost allocation and we're thinking of like the future buyer, right? How would you think of cost allocation at the like platform level versus like the opco level? So for example, the future buyer, including the CEO cost as an example, like how do you think about that cost allocation aspect?
So you're saying from the perspective of the person who's going to come in and buy the business from you?
Correct.
For the cost allocation, well,
and specifically as it relates to like the valuation, right? Because like I think there's a cost of a business, but then you can look and you can say, here are the costs that are related to the integration of this business. But eventually maybe those costs will like minimize over time. Then there's costs that are relating to, the platform and the aspect of just continuing to roll up these other companies. And I feel like I've heard it get after you go into it more, it gets very dicey there's all these different things that you're pulling out and you're saying, oh, this is going to be a part of it. This is going to be a part of it in the future, and ends up making, this thing is showing like maybe in the P&L it's showing a 5% margin, but the people are looking at it like, oh, this actually could be a 12% margin. And it's not probably like one simple answer, but I guess what is your perspective on like there's these current costs in this current organization and what they're trying to do, and now you're the next buyer trying to take it and theoretically increase the value, but you're trying to weigh, what am I doing? How are these current costs going to pertain to these the costs that I'm going to be taking on?
And so just to be clear, so you want that from the perspective of me as the buyer coming in to look at your business, right? So the way that I would think about it, so again, it depends. So let's say I'm just a PE firm and I'm sitting on a couple $1 billion and I'm looking to buy a business in this space, and I like yours, right?
Yep.
I think there's a few things. I mean, one is you're going to have, like, me as the buyer is going to go on there and look at it. And again, as long as I understand the business and I know like where the levers are, what's important in the business, and I'm buying it just as it's on its own as a standalone business. I will know what capabilities I have on my side of the table that I can eliminate or reduce or change. Maybe we hey, the CEO is making $3 million a year. We're not going to maintain that. And we have another guy that we're ready to drop into the seat. And, he costs $1 million a year and it's going to be, $2 million savings. So, there are all, you go kind of line by line and look at those things as the acquirer and see, okay, what impact does that have, on the, the profitability of the company? Because, there's different ways that different businesses get valued in different industries, right? So, some are a multiple of revenue, some are a multiple of EBITDA, some are a multiple of net income, some are a multiple, or some are traded book value. So you first have to understand what you're buying. But assuming you know that, book value is an easy one because it's just assets as a company, right? So that you don't really worry too much about the margins as much as you would in a business where you're buying it for a multiple of EBITDA. So you're paying for that cash flow. And you have to just be realistic about what can be eliminated and what can't be eliminated. I'll give you a perfect example. I have somebody that I work with, is a good friend. Their company was publicly traded and it was just taken private by a private equity firm. In that negotiation, the private equity firm identified pretty early on that I think he was the EVP. He was the EVP, but he had all the significant sales relationships with all their big customers, right? And if he left, those were in jeopardy. And it wasn't the case where I could just plop Shaun in and he's going to be able to just say, hey, I'm the new guy. I mean, this guy had years of, all the typical, dinners and golf outings and trips and conferences and everything and relationships where that's critical. And that transaction, he said to the CEO, he's like, this guy has to be locked in for 5 years or we're not buying the business, right? And whatever it takes to keep him, we're keeping him. So in that case, they paid a retention bonus, like a stay bonus. They said, we're going to give you money to stay, right, up front, and then built that into the acquisition price because they knew 30% of the revenue of the company is tied to this guy. And it wasn't a guarantee that it would leave, but it certainly made the probability a lot higher. And it's a very competitive space. So they're like, it's not like these guys can't get this service from somewhere else. So that relationship's critical. So you also have to, again, we keep going back to the same few things, but it might look one way on the financials. And you can say, oh, this guy's making $4 million a year. Who is he? We can get rid of that guy. And then you realize he's generating $300 million of the revenue of the company. $4 million is a steal for this guy. And if he walks out the door and we just paid 10 times EBITDA for this company and 30% of the business walks out the door tomorrow, we just paid 30% or 30 times EBITDA for this business. So I don't know if that's answering your question directly, but it's, you've got to look at who the people are and, what are the critical points in the chain or the critical links in the chain that you don't want to disrupt. And in some cases, you might want to incentivize to stay. So I think, I think it's, and then you also have to realize, like, one of the things that we always do when we look at the models, and you do have to do some modeling. I'm not saying you don't do any, but we take like the savings that we think we're going to get on different line items, and then we discount them. Right? We give ourselves some buffer, right? We say, how much of this do we really think is going to drop to the bottom line? And business we were talking to yesterday, we thought it was about 90%. Now it might be more, and it probably will be more, but we're going to be conservative and say, okay, we're going to save 4% on COGS, we're going to save 8% on personnel costs, or this, and then we're going to apply 90% of that to the bottom line, and then we'll see what that looks like. So I think you just have to be kind of smart in how and I think you also have to look at, again, this is on a industry by industry and business by business perspective, but everybody goes in there thinking that we're going to cut cost. The most successful, and this example I was giving you before about the company that was just taken private by this PE firm, one of the things that and they're going to be, it's still early in the game, but so far so good, I think they're going to be very successful, is they agreed up front to invest $50 million of new money into the business after they bought it. So they weren't, they're going to get some savings here, there, wherever, but they weren't looking at this as like, hey, we're going to come in here and start cutting costs. We're going to buy this and start investing in the business, right? And that's a totally different perspective, right? So they're coming in, and this was about $1 billion transaction. So another 50 million at the end of the day, it doesn't make that big of a difference in the purchase price. But it makes a huge difference in how you're going to look at that business going forward. So, the best outcomes have been where you've been able to grow the top line and the bottom line.
Yeah.
That's where you're getting your big multiple expansion at the end.
So the last few questions, I actually want to get into the actual value creation and exit side of this. Like, do you think this concept of multiple arbitrage is still as strong of a thesis as it used to be, of just small business lower multiple, bigger business higher multiple?
Yeah, I think there is something to that. Okay. And I think that that's always going to be the case because the bigger guys, let me give you an example. So banking, right? In banking, there's a sort of, and when we were running our Sentinel Funding Group and Insure Capital, just as a kind of an adjunct to that business, we invested in de novo banks, like startup banks.
Okay.
That was a very, for a while, it was a very profitable way to invest. And the reason that we started to do that, and I think this answers your multiple arbitrage question, like the big guys paying more, is there was just a fundamental understanding in the industry that Wachovia or Bank of America or JP Morgan, they don't want to go into a new town, open a new branch, go through all the regulatory stuff, raise the first couple $100 million of deposits, hire the people, get it stabilized, bring it to, open the second branch, open the third branch. That's too risky for them, and it's not what they're very good at, right? So they're willing to pay a premium because they can for you to go out and do that work and take that risk. Doesn't work out, that's on you.
Yeah.
If it works out and you get to X amount in deposits and Y branches, we're willing to pay you, banks trade at multiple of book value. We'll pay you, 2X book value. Like, we'll pay you more, but because we know, because we're Wachovia, or they're not around anymore, but we're, Bank of America, we know what to do with it once we get our hands on it, right? So we know we can get that value back, right? We know where the economies of scale are going to come from. So you go out and take the risk. You run around, right? So think about that in these other businesses. If you're Sequoia, right? You don't want your guys running around buying a $10 million business here, $10 million business, $10 million business there. You want them buying $100 million, $500 million, $1 billion businesses, knowing that you're going to pay more for it, but that time and money is better spent doing other things. Yeah. Let these guys go out and aggregate them together and go through the mess of the integration and all of that. Show that it works. Now they, that we de-risked it.
Right.
And what they're basically paying is they're paying that premium. They're paying that premium to you to de-risk it. And that is not going away anytime soon. It's like, think about the beverage business, right? How hard is it to start a beverage brand, like a new, and you see them pop up all the time and they go away. But every once in a while, one will, pop and Pepsi will come in and buy it or Coke will come in and buy it. Why? They got all the shelf space, they got all the distribution, they got all the production facilities, they know what they're doing with it, and they know exactly to the penny how much of that they're going to sell that you're not going to sell just by the fact that they're Pepsi or Coke or whatever. And so, you look at the prices that they pay and you look and you're like, full transparency, I am an investor, but Liquid Death is an example. They're going to be acquired very soon. I mean, they're just blowing up. And the buyer of that will be able to tell you exactly how much more they're going to make just by putting it into their distribution,
Yeah.
and lowering the manufacturing costs and all
Right.
the other stuff that they do. And so when people look at it and they say, that's a crazy valuation for water in a can, one, they've done an amazing job.
Yeah.
I don't, again,
Yeah.
I don't know what your thoughts are on it, but they've done an amazing job. But two, somebody's going to pay them that much for it. Like it's worth it for somebody, one of the big beverage companies, to come in and pay extra for it. So I think that will always be the case.
And I mean, if you think of like, there's the acquisition, there's the integration, then obviously, in theory, ideally you're going to then exit that and turn that around to, it could be a couple of other, it could be a larger PE firm, it could be public markets, it could be a strategic acquirer. In that world of the exit, do you, I think overall, like sellers and buyers, sophistication will probably continue to develop and improve, more information accessible. But what do you think do you think depending on who you're selling to, they're looking for drastically different things in the business? And if so, what do you think kind of the exit options, what do you think they're looking for in a really successfully well done roll-up event?
Yeah, I think they are looking for different things. I mean, a strategic buyer is going to be looking at this and how does this integrate and help my existing company grow,
Go to the next level,
go to the next level and get bigger. So they're going to be looking at certain things around that. That'll be different than just a pure financial buyer, which could be the public markets or a PE shop. And all they're going to be looking at is, how fast is it growing? How much money is it splitting off? Is this sustainable? Where's the money? They're going to be looking at it, probably like you guys look at a stock. It's like they're going to be looking at much more from a financial perspective than an operational perspective. When at the end of the day, I mean, if you break that out, the public market investor and the private equity investor are very different. I mean, you know that better than anyone. So there's, believe it or not, I would say there's more, I want to say diligence. There's the perspective from the PE guys. So one of the things is, again, think back to the model. It's like, they also want to financial engineer these things, right? And so they're also going to be looking like, how much debt can we put on this? How much can we pull out in dividends? What kind of distributions can we take without, running the company to the ground? And the public market investors can be like, I want to see growth. I want to see margin expansion. I want to see, different fundamental things. But I think they are going to be looking, if you're thinking that my exit is going to be to a strategic acquirer, I guess one thing that I would say, and I say this to a lot of these founders who say, or managers at that point who think they're going to sell, is you also have to, if you're going to sell your pet food business to Purina, can they run the business the day that you leave? Like, is it operationally possible? Like, if you weren't there tomorrow, the business would still continue to perform. And if your business is still built around you, and if you step out of the business, the whole thing falls apart. That is not going to be attractive to a strategic acquirer ever down the road, because it's just going to be too hard for them.
Do you think that people should have really clear who they want to sell to, like as if that'll influence how they're going about their roll up in a really impactful way?
Yes. I think the best thing is even start, a year is enough time. I mean, it sounds like a long time. A year is enough time to say, okay, we think our most likely exit is to strategic. Let's start getting the company in shape, prepared, ready for a strategic buyer to come in. If that doesn't happen, we still have a financial buyer and we'll still be fine, right? But if you go down the path of, I'm going to go, the financial markets, IPO, very different, right? Sort of set of things that you're going to need to be prepared for and get ready for. You might want to bring in a different CFO, somebody who's run a public company before, somebody like things that are going to signal like, okay, these guys are, they have their shit together and they're ready to be a publicly traded company. So you do have to do some planning ahead of time, and where that becomes more challenging, going back to the very beginning when we were talking about this fad of buying these businesses, these small, boring businesses that everybody thinks they're going to go and get is they're not ready for sale, right? And a lot of them are being marketed to, like PE firms, and they have SDRs that are out there like just blasting out to every roofing contractor in Connecticut, do you want to sell your business? And some of them are like, sure, but they're not ready to sell. And so you get into diligence, and then they pull their hair out and being like your financial statements are a mess, and I can't get it. And they're like, well, yeah, because we're just running it for ourselves. They're fine for me. I don't need anything more. This is good. But you're the one who wanted to buy this thing, so don't bitch at me because it's not in good shape, right? Versus somebody who's deliberately saying, okay, we're ready to take this out to market and maximize our value. If you can start 12 months out and work with somebody to get you in position, you're going to have a much easier sale. All your shit's together, your financials are clean, you've gotten all your SOPs down, and like all this stuff that you got a nice clean data room. Somebody shows up, you're going to get a lot more for that business than if they've got to come in and you go out and market it and it's still a mess, right? So but if somebody just approaches you tomorrow and says, hey, Shaun, I want to buy your plumbing business, and you're like, cool, right? Then you turn it over to them, and that's on them at that point.
Dude, I have like so many other things to ask. I honestly think that we haven't even gotten to the venture capital side.
We'll do a part two.
We'll do a part two. This was epic, very valuable. Thank you. I have maybe last closing question for you. What are you personally most excited about this year over the next 6 months?
It's great. I think I'm excited. So I'm finally so I left my firm back in May and started my own firm. So I'm really excited about sort of getting that up, running, kind of building a little bit of momentum behind that. It's been it's been a long time since I've kind of been completely in charge. I've been either in a family office or at a firm or at a company. So I'm excited about being able to kind of build something around all the experience and the work that I've done and kind of plant my flag and see where this can go. So I think for the next 6 months, I think that's going to be my focus.
Love it. Anything else on the topics we covered that you're super passionate about that you want to share, mention, lastly for anybody listening?
I think the only thing, and we were talking about it before, is just be careful. If you're thinking about M&A, you're thinking whether you're an established company, you're thinking you're going to do a roll-up or a holdco, get some advice. Like, bring somebody around who's done it before. We talked about it. Everything looks so easy after the Olympics. Like, you watch these people. Don't try and DIY it. It's worth it. You're going to get a much better result by finding somebody who's been there, done that, and has seen all the stuff that you haven't seen before. It's well worth it to do that. So I guess that's my my big takeaway is like, don't DIY this. It's more complicated than you think, and I've just seen too many people vaporize too much time and money trying to do it on their own.
Where can people find you? Where can they keep up to date with what you're doing, what you're focusing on, what you're thinking about? What's the best place?
I mean, we'll have the website cleaned up now, but you go to CISVentures.net. That's the firm. We'll have CIS Partners will be up and running pretty soon. Still working on that. But you can reach me. I'm not a big social media guy. You can find me on LinkedIn, but we're just starting to get all that set up. Nice. But go to CIS Ventures, reach out, and happy to have a chat.
Awesome, man. Well, dude, thank you again. I can't thank you enough. Not just for this convo, but everything else that you've been helping us out with for the past few months. So this is awesome, and I'm excited for part two for sure.
Appreciate it. Good luck with it.
Awesome. Cheers.
Cool, man.